Hi out there, it's Jonathan Bengal with JB Financial and Naked Tax Talk. And I'm going to cover today the difference between distributions, wages, and dividends. Now, I'm going to try to explain this with my talk because I don't really have any visuals at the moment. But if I may, I'm going to use an analogy to explain how all of this kind of works. So let's set up the basis. As many of you know, you are in business for yourself. Ta-da! And when you are, and you started your company, you woke up one day and you're like, I'm going to create my company. So you did. Now, you realize that all of a sudden you need tools to do your job. You need software. You need if you're lucky enough to hire people to get the ball rolling, whatever. The point is you need to start investing money in your company so that it can start producing revenue, AKA sales. So you get out and you just start. Now, if we were going to do this startup in the traditional way, because many taxpayers, to be honest with you, many taxpayers, entrepreneurs, don't necessarily go through the step I'm going to tell you. But if we could imagine for a moment, if everyone did it like this, which is to basically pretend you're taking money out of a till, or better yet, you're not taking it out yet. You're going to put it into a till. So I am going to get some money, and I'm going to make this $10. And this is going to become what we call my contribution into my company. It's what I'm going to use to start my company. Now, it doesn't have to be cash like this that's going into a till, for example. That's not normally how it works for many, many, many business owners. Usually what happens is we take out our personal credit cards and we just swipe away. We swipe our credit cards, personal credit cards, to get the business going. It's equivalent to me taking cash and putting it into a till. So let's pretend that we sell a product, because this might be, I'm getting to the analogy here, I really am. So let's pretend you guys all sell a product. And actually, some of you probably do sell a product. So, and let's even go a step further and say, let's say you have a storefront. So traditional storefront model. So now you have a storefront and you open up the doors and you have put $10 of your own money into the till, because guess what? You need change when someone gives you more money, or you need this money to pay for expenses that need to come out of the till. So this money is funded by you originally, put into the till. Okay, so we call this a contribution in accounting and tax world. So now, here's the thing. If I am a sole proprietor, so not a corporation, but a sole proprietor, then I have an option here. Actually, I don't have any options. The only option really is, how do I get paid out of my investment in terms of investing in my company? So how you get paid is really easy. You've got $10 in the till that you put into it. And let's say, for example, you sold a widget, okay? You sold a widget and you charged $1 for the widget, okay? A really cheap widget. And in fact, I think the dollar store is going away, but I digress. So you've got $1, and so the person gives you $1. Oh, thank you very much. And now this is your dollar that you earned. And where does the dollar go? It goes into the till, correct? Now, I'm not really an accountant, am I? I only have a degree in business accounting. But anyways, so you see here, I got 10 and 1. How much does that actually make? We all know $11, right? Now, this $11, bonus question, how much of it is actually taxable? So the answer, just the $1, because that's what you earned, not the $10, because if you remember, that's what I put in as the business owner in order to get my business started. I had to fund the till. So the $1 comes in. Now I've got 11, okay? Then you're going, I need to pay rent. I need to pay, I need to pay, personal rent, and I need to pay, my car loan, or I need the money now out of my company, because that's the whole purpose why I created it, was to make money. So then what you do is you go, oh yeah, there's that $10 that I put into my company. I'm going to take that out now. Thank you so much. And now it's over here, and now it's in my personal pocket. And then I go and I spend it on personal things. That $10 represents what we call a distribution from your company. It's basically you're taking out what you originally put in, let's say, the investment of your hard-earned efforts to make money. Why is that easy? Because you have $1 in the till now that can actually start paying for other expenses as they come along. You just put the money in originally and you took it out. Distribution. Now, distributions are also true if you were a single member LLC. It's true if you were a partnership and a partner. If you're a partner in a partnership, it's true if you were an S corporate holder, a C corporate holder. The point is anytime you take money out of your company that you originally invested into it, you can take it out and we can call this a distribution. Now, if you are a sole proprietor, a distribution is what we would consider a tax-free event, meaning that I took out the $10 because I originally put it in and I took it out. The government doesn't tax us on that because we put the money in it ourselves. If you are a sole proprietor. Now, if you are an S corporation and you do the same, you apply 10 bucks and then you take it out later, we call this a distribution as well, if you remember. The government, for the most part, looks at that and says no tax dues, tax-free distribution. That's a great thing, isn't it? Now, there's one catch though, because we all know that limitations do apply. And the limitation is if I have just $10 in my till and I take out $11, okay? So there's 10 here, but I take out 11. So what's my problem? For us math gurus out there, it's a negative $1. How's that possible, you ask? Usually it's because what's happening is entrepreneurs are using their credit cards, right? Which is exceeding what they originally invested in their company. So I digress. So you have a negative $1 that you took out that didn't exist, right? So your till is actually in the loss of $1. That $1 now, that negative $1 is now what we might consider, well, it is, if we talk impurities, it is now what we call a taxable event. And we call this capital gains because ironically enough, you took out way more money than you originally invested into your company. And now the government says, oh, you took out way too much. Now, ding, ding, we're going to smack you and we're going to hit you with this thing called capital gains tax. If you are a C corporation, works in the same manner, very similar manner. You take money out of your company. It's a distribution. It dilutes your stock value. Basically, you're exchanging your stock out or you're just taking out your investment. Something to that effect. Now, again, this episode is meant to just be real surface level. It's not meant to be super, super dive heavy. You know, let's get into the details. It's just very surface level, right? So for my tax experts out there going, just calm down. Just know that I'm only covering just the real basic surface here. So my point is that distributions, for the most part, are tax-free events. This is how you get money out of your business throughout the year, or maybe you don't. Maybe you just keep it there because you need to use it for down the road, maybe because you're going to invest in your company again and either hire coaches, or maybe you plan on hiring certified tax planners and coaches and IRS enrolled agents. The point is now you're taking your money and reinvesting it. So that's one way in which we get paid. Now, this message does not apply to my sole proprietor, my single member LLCs. This does not apply, right? Nor does it apply to my partners. The following conversation applies to S corporations and C corporations only. C corp, I don't know which one's the C, but the point is C corps and S corps only. And what is that? It's this thing called a wage. So we all remember, I'm sure, in time of our lives, that we used to be employees for someone out there, and they gave us this thing called a wage, an hourly rate, or maybe some of us had a salary. But the point is, we got paid to work on behalf of someone else. When you are a C corporation or an S corporation, you are seen to be working for your company, and therefore you can issue, and in fact you must in some cases issue wages to the shareholders for managing and running the company. So now this is called a wage. So I get a paycheck every 2 weeks, or maybe once a month, or weekly, or however, and it looks like, you know, a regular paycheck comes in here, it says net deposit, and now that goes into my personal bank account, and I go and I buy the things personally that I want in life. And so as a result of this, the wage now becomes taxable income to you, the business owner, as what we call W-2 wages, and is now subject to ordinary income tax. Now, not only that though, but we're also having to account for FICA tax, Social Security, and Medicare. That's what FICA stands for. So now all of a sudden, we've got an expense called FICA. Now, here's the cool thing though about the C and the S as it relates to wages to the shareholder, is that the government recognizes that you are an employee of your own company, and therefore you are entitled to deduct the wage, including the employer portion of FICA taxes, which is 7.65% at the time of this recording. Now, with that in mind, that's another way in which you get money out of your corporations, is through a wage. But remember, that wage is what we call a taxable event. So you're going to pay taxes on it, plain and simple. But with the right planning, though, it actually sometimes turns out to be a wash if the right plan and the right strategy are being utilized. So if you are a business owner, an entrepreneur, and you're really curious about how it is that I can really maximize how much money I can legitimately take out of my company, be it as a distribution, or be it as a wage, or be it as many other tax strategies that we can use, hit me up. I'm Jonathan Bengal with JB Financial. Feel free to shoot us an email at info@jbfinancialllc.com. And if you're kind of curious about what type of bathrobe you are as it relates to your tax personality, because some out there who may or may not know it, but I'm the host of Naked Tax Talk, and what we like to talk about and use are bathrobes to explain our personalities around taxes. So if you're curious, text 555-888 to the word "Let's Get Naked," all one word. Let's Get Naked, all one word, to 555-888-8. So with that in mind, if you're also curious and you just want to book what we call a mutual exploration meeting with us and see if maybe we might be a good fit, maybe see if in fact we have some opportunities to save you millions of dollars in taxes, feel free to reach out to my website, jbfinancialllc.com, JB as in boy, financialllc.com. Click on book now and follow through with the mutual exploration meeting. All right, guys. And if you are a current client of mine, I hope that you found this video valuable and yet more content provided to you for being so valuable to me.